And that means we are live here on our halftime report, Tackle Trading's daily market show, where we break down all the news, the action, the information that we think is relevant or interesting, and try to have some fun while we're doing it and give some value out there to our community. A couple things. Number one, if you're first joining us and this is your first time here, welcome. As always, click the subscribe button, click the bell. Make sure you come back each and every day whenever the markets are live. We are live at 12:30 Eastern Standard Time. Several other things. If you're Team Tackle and you've been here for a long time, just pop in the chat, hashtag Team Tackle. Let us know how you're doing and give me that thumbs up to help us get the word out for our community. Several things we're going to be talking about today. Number one, the jobs report, obviously historic levels that we have not seen since the Great Depression. Market doesn't seem to care, obviously. I'm going to get everybody's take on that and our analysis on what's happening and what we saw in that jobs data. Also got Fed futures now pricing negative rates for the first time. Matt's been calling that for a long time. Bitcoin's rallying. There's an earnings roundup and more chatter about China and the trade war as well. Matty, how you doing today?
You know, Tim, I'm doing really good. Excited to be here with the halftime crew to kind of navigate the markets today. A lot of news out there, especially macro news that's kind of driving the market today. Yeah. More macro news today driving the market than individual company news.
Big picture news. There's no question about it. And the themes, and obviously it's been a very bullish week for the market. If you think about it, on every Friday, we have one of our most popular, coaches over at Tackle Trading, Frank Martin. Coach Frank, how you doing, brother?
Hey, how we doing, guys? You buried the lead. I thought that it was going to be Friday Frank Day first, but I see where I fall in the pecking order of things. Great to be here as always, though, and hope everybody's had a great week, both in and out of the market.
I have a tendency to bury the lead, Frank. I need to always remember the most important thing, and that is Friday Frank Day, fun day, and all the alliterations that bother Mark, I'm guessing. Mark, yes, you're doing great, right?
I am doing great. I am. I mean, not making as much money as I'd like, but that's my biggest problem these days is I hate that all my naked puts keep expiring, but there are worse problems to have in trading.
Yeah,
come on, get some courage. Go directional.
Yeah, go long futures.
That's not going to happen
on futures.
in this insanity.
I knew Mark wasn't going to make it Friday to Friday. Last Friday he was all about the team, rah, and then I caught it yesterday. I caught it yesterday.
But this is insanity that's happening the last couple of days. It is a psychotic disconnect with reality, and I can't support it as long as it's happening. I'll get back on the team once a little bit of reality sets in.
Cody,
I thought the point of the team was that it was irrational.
And there's a level of insanity. There's only so much insanity one can accept. Listen, President Trump, when he was asked about the unemployment report, in his own way, he said it was priced in. He's like, everybody knew about that already, Mm-hmm. So there's Trump pricing it in. Listen.
So Trump's part of the team?
Well, it depends on what he does on China.
Cody,
depends on what he does in China, but we'll get into all that here.
First of all, Cody looks more Hawaiian than he ever has in his life. He's laid back in whatever lazy boy that he's in. He's got his Hawaiian shirt on, broadcasting and producing the halftime show from
there you go.
Yeah, from Oahu there, Cody. Great to have you.
My office has been commandeered for the week and for next week as well. So
I got you, brother. I got you. Let's get down to the analysis. Let's talk markets here for a bit. Matt, I think we got to lead with the jobs report, obviously, and talk about that data. President Trump says it's priced in. Mark does not understand the break in the logic between what the market is doing and what is happening in the economics. Let's start with the actual numbers. What did we see in this jobs data, Matty?
Well, what was interesting, I mean, I do agree with President Trump that everybody kind of expected a really, really shocking number, right? I mean, even on the expectation on the unemployment rate, we were expecting a 16% unemployment rate. We came in at 14.7, so obviously, it didn't come in as bad as expected. Was it priced in? My opinion of everything, every news cycle, every bit of analysis we ever see, somebody says it's priced in. So I do think there is some truth to that we all knew that the number was going to be a really, really negative number. My priced in argument always goes into the fact that we don't know the data 6 months from now, right? That's when I get a little frustrated with the arguments of everything getting priced in. It's not that this month, because everybody expected a very, very nasty number this month. But let's kind of go through the numbers a little bit. We did come in at a 14.7% unemployment rate versus the expectation of 16. March's unemployment rate was actually revised to the negative, which I also expect this unemployment rate to be revised to the negative next month as well. And it was revised from 701,000 jobs from last month to a negative 870,000 jobs lost in March. So that was revised to the negative. We currently have about and further going into the numbers, you have about 4.7% increase in average hourly earnings. And if you look at this number here, I mean, that is a big time number in the increase in average hourly earnings. When you look at kind of the data on that, look at how big of an increase in average hourly earnings. And that was kind of a little bit of a headline number, but to me, that number is completely discounted because who lost their jobs, guys?
Low-income workers, obviously.
Low-income workers,
first,
right?
yeah.
So the average
workers.
hourly earnings were obviously increased because it wasn't exactly like the CEO lost the job, or the CEO lost the job, or the director of sales lost the job. It was the workers who lost their job, right? So that number, I think we can just discount a little bit. But just to kind of give it a little bit of historical understanding about this number that we did see here today, because it was absolutely a historical number. The last time we saw these types of numbers was back in the Great Depression. And when we saw these numbers in the Great Depression, it was really the worst unemployment rate we had in the Great Depression was in 1933. The Great Depression started in October of 1929. It took 4 years to go from where they were at a normal labor market cycle to really kind of meet that low point. It took us about 2 months to get to that. Now, obviously, we have a different economic situation going on today than we did in 1929 to 1933. But I also do believe that some of the COVID-19 situation has simply unmasked some of the problems that were underlying in the economy before the COVID-19 situation even came in. The participation rate was a little interesting here. The participation rate is the number of people that participate in our economy. The unemployment rate is the number of people that are filing and on unemployment benefits. That does not take into account people that come off the unemployment number, who are no longer seeking a job, who are retired or stay at home or whatever the case might be. That number fell to a low of 60.2% versus what it was last month at 62.7, and that 60.2 number goes back all the way back to the 1940s. You also had the high in terms of the 20.5 million jobs lost in April of this year. That was the worst number since really September of 1945. And in September of 1945, you had an unemployment rate, a job loss, of about 2 million in September 1945. But that was due to the unwinding of World War II labor market, right? So this is obviously a very, very historical number. Is it a one-off situation where we just start going back to work because the economy's reopened? I think that's the debate that a lot of people are having here today, and the debate we're going to be having probably for the next year or 2 years in terms of how long this economy is going to take to recover from the shocking numbers we are seeing from an economic perspective. But overall, I mean, it's not as bad as it could have been, Tim.
Mm-hmm. Well, and that's the real thing. I mean, I think a lot of the traders right now that are buying into this rally, Mark, that are on the team, whatever the name of that team is, they're saying, how can it get any worse than where we are? And we're already starting to see to where it's not coming in as bad as it was. And from what I read, Matt, a lot of workers who are currently laid off, they expect to get the job back within 6 months. So there's this narrative of hope.
Keep hoping for that.
Well. Yeah, Mark, how did you interpret the jobs data? What was your reaction to it?
A lot of people, listen, there is a disconnect between economic reality in America and the stock market. Now, as traders, we know that we can take advantage of that, and it doesn't matter what reality is. We trade signals, we trade price action, we trade breakouts, we trade whatever the system is, we trade. I had a student email say he had OKTA. He had traded the breakout of OKTA, and he was looking, one of our pro members saying, what would you do in this situation, to take profits, and I just said, here's about 4,000 possibilities of how to manage a trade. Pick the one you want. But our traders, our pro community, we teach them to trade signals. So like when he traded the breakout, doesn't matter if it's insanity, doesn't matter if it's irrational. We trade what we see on that short-term horizon. There's always been money to be made. And let's be honest, there's been a ton of money to be made on the bullish breakout side, on bullish pullback side. And so how long can the disconnect between reality and stock price movement goes? Well, we keep trading, we keep doing our thing, we manage accordingly, position size accordingly. But would anybody be surprised if this market hits all-time highs this summer?
No.
Like it doesn't matter if that's a disconnect to reality. It's sentiment, it's momentum, it's euphoria, it's all of that. I mean, you have to take advantage of setups and trade them accordingly. And those type of traders that are doing that right now are not doing too shabby.
By the way, whoever that student was traded OKTA, I'm sure Breakout Frank is proud of them right now.
I'm
Frank.
very happy that yes, we're good friends. We got similar tastes. We'll call it like that.
Pretty clean technical breakout there. Back on the jobs data for a second.
Very good technical breakout. And I'm sure Mark talked about when he was talking to that member of our community about trailing that stop losses, underneath the lows of the day, maybe locking in profit, scaling out of the position. There's a lot of trade management you can do on a breakout that has momentum. But when you have momentum like this, you really don't want to start just locking in complete profit until you start seeing some slowing momentum. So, you just trail that stop loss bar by bar, I'm sure.
That's exactly how I would do it. I'd scale out.
I mean, once again, and we teach these techniques to our pro members. I think what he decided to do was he had 3 option contracts, maybe get out of one of them, maybe hedge the other 2 with out of the money calls to still, one of those. You don't have to do all or nothing, right? You can take a little bit of profit, find a way to maximize other profit. There's a lot of things you can do to maximize a trade. I mean, traders, when they have information and education, they can do amazing things.
I want to make a, kind of a devil's advocate argument here. Maybe joblessness is bullish because these workers that did lose their jobs, Matt, they were low income workers. The $600 a week from the CARES Act extended to 39 weeks. Now somebody who was usually on unemployment going to get $200-300, now they're getting $700-900 a week. So they might actually be making more money on unemployment than they were when they were working. Is there any, because I'm reading that across different media sites. They're like, hey, who cares that they're unemployed? They're making good checks right now. They're getting the stimulus money. That money is going to go back into the economy. Now it might create massive inflation, but maybe that's why the market doesn't care, because that market clearly does not care about the jobs number. It hasn't cared.
That's fine. But then let's talk about supply side economics and supply chains. I mean, I don't understand how that could be a bullish thesis. I get it. People are like, okay, they have more money. They're going to spend more money in the short term, but that just has a very nasty economic impact long term. You can't have it both ways. We've talked about this all week long. You cannot have it both ways. You can't say, the market's bullish because, people with unemployment checks are spending more money than they did when they had a job, but yet the economy is going to have a V-shaped recovery and the labor market's just going to contract again.
No, and I'll buy your argument in short term. Like, once again, if the government magically prints $1 trillion and gives it to us all, it's going to put a lot of money into the economy in the short term. But Republicans have signaled very, very strongly. I think Lindsey Graham, the words he used was over our dead body, that thing would be extended past July. So, they have absolutely 100% signaled their unwillingness to extend that $600 bonus past July. So if I see Republicans pivot on that point, I'm going to play a breakout on that on the short term somewhere. But that they've been very, very behind closed doors. They hate that $600. Hate it.
I think it just kind of highlights the general debate in the markets right now. It's the short-term euphoria versus the long-term reality checks, and which ones that you buy into and that you're watching. Obviously, I mean, you got a little pivot there and whatnot. Jobs data aside, we also had other data on China. Go down to a 5-minute chart if you can here, Maddie, because some of that action actually, guys, I mean, if you look at the intraday and when we started to run, it wasn't necessarily just on the jobs numbers. In fact, jobs numbers kind of held us up.
Didn't have that big of an impact, Tim. I mean, it gets the headlines today, right? Because worst jobs data since the Great Depression, since the 25% unemployment rate in the middle of 1933. Worst 1 month, increase in unemployment since September of 1945. That's all the headlines, right? But the market really responded very, very, very little to that actual numbers. I mean, when you're looking at this data, right here's when the jobs data came out, right there. Market really didn't do much of anything. It's just in this little bit of neutrality from an intraday perspective. What really kind of drove this market, and it's going to drive market a little crazy, is there was a headline yesterday, last night, that basically stated that, President Trump and President Xi Jinping, they have agreed to not basically go all mutually assured destruction from an economic perspective. And they're going to agree in principle to fully agree to meet the obligations under the phase 1 trade deal. And that's when the market really started driving up, is in that overnight action after the market closed, when all those headlines were saying, okay, China and the US are going to honor the agreement of the phase 1 trade war. But the reality, and I want to get Mark's take on this, the market never sold that, Mark. I mean, in the last week and a half that Trump has seen an increase in rhetoric against China, which I believe is just politically motivated more than anything. But in the rhetoric, we've seen an increase in that, but we never seen the market really kind of sell on that. And now all of a sudden we're re-emphasizing that we're going to meet our obligations to the phase 1 trade deal. China says the same thing. Market responds bullish, up 300 points on the Dow, up about 30 points on the S&P 500. But the jobs data is shockingly, I mean, if you were to tell me a month ago that the jobs numbers would come out and it would do absolutely nothing to the price of the market, but yet the phase 1 trade deal that was signed, my God, when? 6 months ago?
Yeah.
Would be the catalyst for the market going up 1.5 points, I'd have called you crazy.
This whole thing with China is really fascinating. By the way, it was Robert Lighthizer and Mnuchin and Liu He out of China. They were reiterating that they were talking here. Mark, it's
let me read you the quote that said at 11:30 a.m. Eastern, just a little while ago, by President Trump himself, not Larry Kudlow, the administration crony, or any anonymous source. This is what Trump himself said on Fox just, an hour and a half ago. I made a great deal months before this thing happened, and it was kicking in, a month ago, and started to kick in and started to produce. And then this happens, referring to the coronavirus situation, COVID-19, and the China rhetoric he's been saying the last couple of weeks. And it sort of overrides it so much. Also, a Chinese government paper told one of the Chinese government advisor in China told one of the papers that the dialogue has gone straight to the ministerial level, and that may indicate that the problem is quite severe. This China situation, and I am adamant about this, that Trump is going to use China in politics, and Mnuchin and some low-level people can say all they want, and they can get all the phone calls, and they can jack the market up to 3,700 on the S&P, and they can make all this nonsense. Trump is going to use China as a political issue this campaign season, and the dialogue and the rhetoric is going to be severe. Like, it is just going to be severe, and it is very tense right now, and it is a hand grenade waiting to go off in this market at any given time.
Yeah, and I agree with Mark that, and Chucky and I have been talking about that for a couple of weeks now, about how the increase in rhetoric really isn't a geopolitical situation, because we see it more as just a U.S. political situation more than anything else. And Mark, do you think that, and I'm just spitballing and maybe a little bit of conspiracy theory here, but do you think there might be some dialogue between those trade negotiators, Robert Lighthizer and, his opponents on the Chinese side that says, oh, don't worry about the rhetoric coming out of the U.S. We're going to honor our
and
deal.
It could be, right? Like, yeah. I mean, that's a plausible scenario, right? It is a plausible scenario that the China and the United States are like, listen, we're going to say some really nasty things about you. But behind the scenes,
same thing on the Chinese side, saying, hey, we're going to say some nasty things, but we got a trade deal. The economic situation, the healthcare situation is more important.
I buy that as a possibility, sure.
Mm-hmm. Mm-hmm. You know what's interesting about that chart, though, right now, guys, we're talking about news that came out in the middle of the night. It didn't take a lot of volume to break that out and run 2%, right? So sometimes these news deals, when they're out of China or when that news is hitting outside of market conditions, I mean, you can manipulate through the futures market some of these price action days, and the whole day today is up based on that information. I wonder how many futures contracts it took to even run that thing, Mark. I mean, probably not a lot.
No, and that's the thing. I can't remember his name. I wish I had the note in front of me. Some really smart guy with some really great credentials. I'm sure when he signs his email, it looks very, very impressive, right? But he was talking about this over the last 6 weeks, how so often you've seen low volume run-ups on the futures. Mm-hmm. Low volume run-ups on the futures, and it creates this disconnect on price, right? That this, and he said whether it's manipulated, he didn't use those words, but he did point to the fact
I'll use them. Markets are manipulated. It feels like they're being directly manipulated by governments lately, because it just everything logic you used about a political issue. Trump wants the market to be at an all-time high, guys.
Wait a second. Shocking news. Governments and central banks manipulate their price action.
I mean, look at the price action towards the end of the day this week, right? It's been really, really sketchy. Yeah. You've seen some good sell-offs at the end of the day in live market action.
Look at some of the run-ups we've seen this week. A lot of the run-ups we've seen this week and a lot of the run-ups we've seen over the course of the last 6 weeks, they don't happen during the actual trading day. And this is not a new concept, guys. This is not just something that is happening during this, COVID-19 pandemic and whatnot. This is something that's been happening for the last 10 to 12 years in the futures market, where you see this, on the overnight action, you see the price go up quite aggressively. On the overnight action, you see the price go up quite aggressively. Overnight action, price go up quite aggressively. But look at the volume on the overnight action. It is minuscule in comparison to the volume during the actual trading day. And so a lot of the price movement that is pushing the market up and up and up and up, it really is just the futures market driving that on some very, very, very low volume. And then when the market does actually open up, you see that volume start to kick in. But what does the market do when the market opens up? It does absolutely nothing. What does the market do when the market opened up? It does absolutely nothing. Market opens up again, doesn't do hardly anything at all. And so a lot of the price action we see, and again, this is not a common theme just over the course of the last, 6 weeks. This is a common theme over the last 12 years, ever since the Fed initially started doing quantitative easing, started doing, and we started seeing, the increase dramatically of high frequency trading systems and so on and so forth. And so it does lead you to some degree that it is the hedge funds that have the algorithms that are driving price action overnight, the international markets and so on and so forth, much more than the actual active participants within the marketplace. But I do want to talk very quickly, Tim, about the technical read here on the chart. Obviously, on the overnight action, we had that big increase in price based on the report coming out of the US and China on the phase one trade deal that they're going to honor the agreement. But now what we're starting to see is we're starting to see a little bit of neutrality. And maybe this is just the market coming into the end of Friday. We got 3 hours left in the trading day. Nobody wants to take a stance either on the buy side or the sell side coming into the market. But you're really starting to see a little bit of a resistance zone form right here at about 1920. And you're starting to see a nice little support level right here form about right there at about 2,900. And that 2,900 is one of those significant whole numbers that the market is just kind of pinged to over the course of the last really 2 months. And so you're starting to see a little bit of neutrality form here, a buy signal above 1920. Maybe you kind of shy away from being a buyer in the market underneath 2,900. But as long as that 2,900 level holds, I remember talking about it earlier on Monday this week when the price action was just kind of forming here. Both Noah and I myself stated we fully expect the market to come in and hit those highs right there at about 29.50. Whether it can retest that significant 200-day moving average next week remains to be seen. But as of right now, bulls still have control.
I love it. I love it. And obviously, I mean, if this was another day of the week, Frankie, that intraday breakout might be legitimate. I know you're not a Friday trader, though.
Yeah, exactly. Yeah, the chart looks nice if we could get a break. I think you could argue on the other side, too, if we broke that support
down.
Little bit of intraday. But yeah, I'm not a Friday kind of a trader, so it doesn't really matter too much to me today.
Yeah,
no, that would be more like a day trade.
If this was Wednesday afternoon, you know, I might be thinking, you know, especially if we broke to the upside going with the momentum. But yeah, I'm not a Friday kind of.
Get a little momentum, a ramp coming into the close, a break of that 1920, just trying to scalp, you know, 10, 15 points to the upside.
Yep.
Let's move through that.
Scalping 10 to 15 points to the upside seems insane, but
it is what it is.
That's how quick it is, though. I mean, that's the market we're in.
This is the world we live in right now. My daughter had to come get me real quick because an emergency broadcast test was on the TV, and she's very hyper conscious of the world that we live in right now, right?
Oh.
And she's like, "What's going on? What is this?" And it's just like, it's just a test.
Yeah.
It's not an actual emergency.
Breathe, right? Yeah, I know.
Hey, my daughter had a COVID-19 test this morning. Like she's having her tonsils out on Monday, and might not be with you at the first of the week, but she had a COVID-19 test. It was really interesting, you know, going in with an appointment, driving in the stall, a guy in a hazmat suit coming out.
Wow.
You know, like, you know.
How'd Pookie deal with it?
Well, she is now aware that her dad lies to her by saying that it wasn't going to be so bad. She did not like it at all. So
every parent's done that in the history of mankind. The
you
kids
got
are
to,
going
right? Like, it's going to be nothing. You got nothing to worry. Just be strong. You know.
Yeah.
So.
Two more big picture areas I want to hit, and then I do want to talk Bitcoin as well. Crude oil market, just quick. What were the rig counts today? Because the chart really hasn't changed.
They come out soon. I'm fascinated with the rig count. Goldman came out. Goldman has turned increasingly bullish on oil. But basically, Goldman's taken my stance on oil, and I love the analysis coming out of Goldman. They're like, listen, you're going to see price stability. Don't expect oil to skyrocket. They expect demand to exceed supply by the end of the month. That was their prediction. So just 3 weeks out, they expect demand to outpace supply at the rate that they go. But they said, don't expect oil just to take off. We got over 1 billion barrels in storage. That's got to work its way off tankers. That's got to work its way off some of the high pricing mechanisms. So they said, as demand starts to exceed supply, oil's just not going to take off, but expect it to trade sideways for a while through the summer until that demand really picks up and can start putting a bigger dent in supply. So the oil thesis I've been jibber-jabbering about for 2 months, Goldman's on board with it, and I like their analysis. And if demand actually exceeds supply by May 31st, that would be a really stabilizing force in the world of oil.
Mm-hmm. Yeah, a couple of hesitation candles. We'll come back to oil obviously every day next weekend. Review it.
That's a pretty chart. That's an interesting.
I want to get Frank's take on it, though. I don't want to just move away from it because, you know, obviously as we saw this, you know, nice little drive up in price, that breakout of 20, very legitimate, comes right back into that 25 to 26 handle, falling 50-day moving average. But Frankie, I mean, on a breakout, this is kind of what you do want to see. You want to see that little bit of consolidation if you're looking at that from a potential breakout, maybe even targeting $30. What do you think?
Yeah, absolutely. You know, and if you zoom back just a little bit, I think we look a little bit like a reverse head and shoulders. And again, I don't necessarily expect it to go to the moon or anything, but we've got a pretty decent level of resistance. We double bottomed last week, you know, running into resistance at the 50, consolidating, you know, good place to sell, right? A sensible location to sell, not really seeing a lot of pressure there. Technically speaking, I really like the break. We get the horizontal break, we get the reverse head and shoulders. We also get the break of the 50 too. So certainly something technically I think you have to like.
Yeah, and I do agree. I do agree with Goldman on the neutrality argument. I think that's what we're seeing in the charts. We've talked about it the last couple of weeks about the massive cuts in oil and dramatic cuts coming out of countries around the world. Cuts of obviously even a little bit of demand coming back into the market with the economy reopening up could outpace supply. I don't know if it's going to happen by the end of the month, but I do like this from a technical perspective. When you drop this down into the 30-minute chart, you can kind of see that overhead right there at about 26.75. You got a very solid support level right there at about 22.75 by 23 as well. And so a break of that high, you're breaking out the 50-day moving average. It wouldn't be shocking to see oil. If you do see that break, it would not be shocking to me to see oil at $30.
Yeah,
no, it would also wouldn't be shocking to me to see oil at freaking $10 again, because those support levels, as they raise, it creates a lack of support underneath it. Moving averages catch up. I think, like, what do you guys call this? A K trade, where there's support and resistance that you can play both ways. Like,
you definitely have K trade scenario here. When you
Absolutely.
overhead resistance, and look at this support level forming right here, though.
Right on a rising moving average.
Support. You got a rising moving. If you break say $23, $20 isn't out of the realm.
We go to an hourly chart on that. We just go to an hourly chart real quick on that. I mean, this type of setup, because say, well, I don't trade oil. Well, forget oil. Like, when you see this setup on anything, I don't care if it's Apple or the market or Macy's or whatever it is, there's a lot of potential to go both ways on this. And this is what, like, assassin traders do. They're like, I don't care if I'm bullish, I don't care if I'm bearish, I'm going to trade the signal no matter what the rest of the world decides, and I'm going to go in that direction. And there's potential on both sides there. It's a really nice setup developing.
Yeah, absolutely. Especially if we could hang out for another few days early next week.
That would be awesome.
Hang out there just Monday, Tuesday, and then break one way or the other on Wednesday. That would be fun.
A Monday, Tuesday breakout on the report that comes out on Wednesday.
I love it. I love it.
I could sign up for that.
Yeah, makes sense to me.
Especially for a day trade.
Yeah, short term. Yeah, either day trade or short.
Yeah, that's all we're talking about on that K trade on the intraday.
Yeah. Quick peek at Nat Gas, Matt. I don't want to go long on this one, but failed breakout here on this chart a little bit. We did break above 2, but now we're back into MAs. Is it more of a channel? Are you liking this pullback that's developing?
If we see a doji. We got to get a doji. And for those of you who do not know what a doji is, I know most of you do. It's just a slowing momentum candle. And so when you're seeing this, you did get a breakout. You did kiss off that 200-day moving average, which is obviously a very significant battle zone for bulls versus the bears. And obviously it kissed off that 200-day moving average, big downward movement in price. It was a little concerning breaking that $2 level mark. That's the concern I have. The second concern I have is we haven't slowed down as we started coming into that bull zone between the rising 20 and the 90 MA, or the rising 50 and the rising 20. So we have not slowed down yet. A little bit of a deeper retracement than I typically like here as well from a technical perspective, but you are in a buy zone between a rising 20 and that 90 MA. You can't buy on increasing momentum to the downside, but a doji upward movement back in price, yes. But as of right now, we're probably 2-3 days away from even seeing something like that occur.
Frank,
yeah,
probably
doji. Now I having my options continually expire on UNG. I've been selling them. Yay or nay? You give me permission to do like a $10 UNG June naked put
today
at the end of by the end of close, or $11, right? Or freak it, say screw it, I'm going to bet support holds.
A $10 naked put. How much time frame do you have?
We're looking 42 days out till the June contracts.
You would have to have something disastrous happen in natural gas to see a 20% decline in that time frame.
Yeah, I mean, right, and I mean that's one of the things is how you play it, right? Because I don't play natural gas directionally. I play it. I don't see. It's like
I would wait till Monday, Mark. Personally,
dude, but I got stuff
He's
to
got
do
FOMO.
on Monday.
He's got real FOMO.
Like, listen, I tried. Listen,
I get it, but Just give yourself one
But
candle.
what if the weather's good on the Monday? You know,
Well, the weather's fantastic out there right now.
No,
Natural gas into the weekend seems we know how the weekend can handle natural
especially after
Yeah.
3 down days that are pretty significant.
and that's reasonable. I'll probably do it anyways, but your advice is really good.
Thank you.
Yeah, but would you do 10 or 11 on UNG? That's the big question. If I am going to do something,
Well,
10 or 11.
10 versus
And I can get like if I were to do them right now, I can get 27 cents on those 10s, and I can get like almost.
Are you betting on
$0.50
support holding or not?
if you're doing it today, I would do the 10. If you wait till Monday and you get a nice little slowing momentum candle followed by an upward movement in price on Tuesday, I would do the 11. No, on a falling day like today, I like the 10 far more than I like the 11. I mean,
I'll probably do the 10 because I mean, what is that? Like you get about
you're still getting a significant ROI here.
all your ROI is insane, right? Like as far as good old fashioned ROI, like what's 365 divided by 42? What is that? About 8-ish?
Yeah.
About 8-ish times a quarter. You know, I mean, that's a good 20+% annualized ROI, not accounting
And that's
for margin.
non-margin. Yeah, that's non-margin.
That's not accounting for margin. That's a good 20%
margin is
ROI.
27%.
Yeah.
But I try not to calculate on margin because then you cheat and you're like, oh my gosh, it's a huge percent. But I don't know.
Well, that's what everybody else does.
Well, listen, we don't want to be everyone else. Like I'm very conservative in my trading and I'm very conservative in my investing positions. And listen, I'm happy making a good return, right? Like I don't have to make a gazillion dollars.
Write that down and remind yourself that every time you feel one of these FOMO moments that you've been feeling.
Well, that's what I do. I mean, right? Like I sold a put on Pfizer yesterday at $31, like it's not exactly the sexiest trade, but this stuff adds up over the course of the year. And it makes me sleep. When I sell up, and this is the thing, and then we'll move on to the next subject. I don't do a trade unless it doesn't impact my sleep at all. If I can sleep, like if I don't think about Pfizer and a naked put on Pfizer or owning Pfizer when I go to bed, then I'm really, really, really happy with the decision. I didn't think about Pfizer till just right now on that naked put. Like, don't do things that overstretch you that if something bad were to happen, it would impact your life. Trading and investing is a game, manipulated game, but it can change your future. Don't lose your sleep or your health or put yourself in a situation where you can have this disastrous moment in your life because you're trying to stretch a little extra money out that day.
That's the longest we've analyzed natural gas in 2 years.
I know. But I guess you guys do like that pullback, apparently. And I get it.
No, not that well.
That's what it is. Quick peek at gold, 2 seconds, move through it, just kind of sitting in the range that it's been for a long time. Then the dollar also sitting in the range that it's been for a long time. Both of them kind of consolidating and range bound. We would need to get one of those breakouts for it to run. What is going on with that chart? That's obviously not accurate data.
Messing up.
Yeah. By the way, just on the dollar, Matt, you could look at UUP if you wanted as well. Yeah. But the interesting thing out of the dollar today, and Matt, you've been saying
I got one question on gold, real quick. Yes, no. Will gold hit 1450 again this year?
No.
Damn you.
I agree with Matt.
I don't think so. No.
Yeah. That's what I worry about.
I mean, for gold to hit 1450 this year, you'd have to be talking about, the economy would absolutely have to rebound, V-shaped recovery. The Fed would have to announce they're not going to do anything with the interest rates and perhaps even raise interest rates. Central banks around the world would have to indicate that they're not going to be buying gold, and governments out of Russia and China and the US would have to say they've stopped buying gold as well. I don't see any one of those scenarios happening.
All right, fine.
And lastly, on our top-down analysis, give me the dollar here real quick, Matt. I did have to bring this one up, and actually we're going to talk Bitcoin for just a second, but I did have to bring this one up with the dollar. The Fed funds futures are pricing negative interest rates in the next 12 months.
I'm shocked, utterly shocked.
Yeah. You've been saying it for a long time. You think you're going to see it? You think we're going to see it this year?
I don't know if we'll see it this year or early next year. But if we do have a second outbreak, I do expect negative interest rates if we do. And personally, I do believe we will see a second outbreak that's larger than the first one, especially as a lot of people in the U.S., even when we were quarantined and whatnot, we're not social distancing in the first place. So, and we've seen other economies open up a little too soon, and we've seen those numbers increase. So I do expect a second outbreak, and we know what the Fed's going to do here. You know, I've said for a very long time, if you understand monetary policy and the history of monetary policy, and it goes decade by decade, you never achieve the highs of the previous decade, and you go lower than the previous lows of the previous cycle. So when you're talking about the market cycle over the course of the last, say, since 1980 till today, in the 1980s, the high interest rate was about 22%. In the 1990s, the high interest rate was 6.5%. In the 2000s, the high interest rate was 5.5%. In the 2010s, the high interest rate was 2.5%. The low interest rate of the 1990s was 2%. The low interest rate of the 2010s was 1% interest rate. The lows of the 2010s was 0% interest rate. So if you're just looking at it from a historical perspective, and not even looking at it from what is the Fed currently doing over the course of not only the last 2 months, but really since September of last year, when they started increasing their balance sheet, doing more quantitative easing, more repo actions. You know, I've long held the belief, and I've been saying this for, man, I don't even know how long, maybe 7, 8, 9 years now. But in this next recession, and we are now going through that next recession, I fully expect the Fed to go to negative interest rates, because the Fed's monetary policy over the last 12 years has really been, it's been the Japanese case study, where the Japanese in the early 2000s started going to quantitative easing, modern monetary theory, to respond to that stagnation that they went through after the 1980s. And so if you understand the Japanese playbook and the Americans adopting that Japanese playbook, it's at this point a probable scenario that either later this year or early next year that the Fed will be at a negative interest rate for the first time in American history. Now, if you look at today, the 2-year note, that is only at 0.12% right now. That's the 2-year note right now. So if you bought a 2-year note right now, you're getting paid 0.12% right now, which is also a record low for the 2-year note. Bond prices are across the board are going down, 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 down. So for me, yes, I fully expect negative interest rates. And I think the Fed at this point, they're kind of stuck. They're kind of stuck in their own monetary policy.
Yeah,
they are. And they've been pot committed for 12 years. This is not something new. And so, you know, it breaks my conservative heart, my fiscal responsibility heart. But the reality is Jay Powell, Janet Yellen, Ben Bernanke, Alan Greenspan, they're not calling us and asking us our opinions on it. We have to follow the price action. And as long as the Fed's going to support this market with aggressive monetary policies, it's going to be a fascinating historical case study 20, 30 years from now.
Yep. Bitcoin next. And
by the way, if you understand everything I said, buy gold.
That's what Swin just said in the chat. He says, thanks, Matt, for
Swin knows you well.
Dollar depreciation obviously is an argument for gold. Is it an argument for Bitcoin? I mean, I'm not the only one making this.
Jones said that today.
I'm not the only one making it now, Matt. And listen, Paul Tudor Jones, you can say a lot of things about a lot of people. This dude's been right a lot in his career. So he's saying it's an inflationary hedge, Matt. Bitcoin chart wise is obviously just recovered tremendously here, and we're starting to break out. And I do want to get Frank's take on the weekly chart when we get there. But Matt, what did you think about what Paul Tudor Jones had to say?
He's making the argument that is nothing new to the Bitcoin community. This argument has been being made since 2017 when Bitcoin went from 2,000 to 20,000. It was being made when Bitcoin crashed from 20,000 to 3,000. It was made in 2019 when it stagnated, and it's been being made in 2020 now that we're seeing the Fed and central banks around the world and so on and so forth. I've heard the argument that Bitcoin is digital gold for 4 years now, Tim. So Paul Tudor Jones saying that Bitcoin is a digital currency can act as an inflationary asset. That's not something I don't necessarily disagree with that, because there are digital asset classes that do act as an inflationary protection mechanism, right?
Mm-hmm.
But to me, it is the raw physical asset that protects against the ultimate uncertainty of monetary policy. Okay, it is not a digital or paper asset, in my opinion. And regional people can disagree on this, but in my opinion, it is not a digital asset class that protects against the ultimate risk to the currency market, and that is the death of currency. And so yes, Bitcoin priced in dollars, you have more dollars, but what happens if there's no more dollars and they go to a new currency, which we've seen over the last 500 years? We've seen it 580 different times. Over the last 100 years, we've seen it about 100 times. And so this is not something that is new to the world or new to the marketplace. And Bitcoin, the argument of digital gold being an inflationary asset, yes, that argument can be made as long as that currency it is priced in, continues to be the currency of reserve around the world for the next 20, 30, 40 years. And I'm just not sold on that argument that the currency, i.e. the United States dollar, will be the currency of reserve in 10 to 20, 30 years from now, as it's been the last 100 years. Reserve currencies, the history of reserve currencies is a fascinating topic that perhaps we could discuss on an upcoming podcast, because if you understand the history of reserve currencies, it goes with the history of economic systems. And as economic systems go, even Rome expanded too far, guys.
Yeah.
Hey, are we heading towards inflation? Yes or no?
Yes, we are.
Yeah, of course.
Yes.
And it's probably a reasonable amount of inflation, right?
Correct.
Yes.
Yeah. So, I mean, it's just, how do you want to play the inflation? Like, some people will say, oh, I'm going to go buy stocks because it's an inflationary asset. We tend to, as a group, err on the gold side of it for many of the reasons Matt just said.
Yeah, but 1 or 2% of your portfolio in Bitcoin is not an argument against having gold in your portfolio.
But is that what Paul Tudor Jones said?
I think he only has like 2% or something like that, Matt. Yeah.
Well, I know. All I'm saying is there's a lot of digital assets that are inflationary asset classes. Real estate is an inflationary asset class. Land is an inflationary asset class. You can make a similar argument to owning land as you could to owning gold, being a physical asset class.
And how many?
There's many digital asset classes that are inflationary products. But again, what is the goal of protecting and guarding against inflation? It's not to offset a 2.3% CPI report. It's the goal of owning gold, and I'm talking about the physical metal. The goal is to protect against the ultimate economic risk and not just a typical economic risk.
And how many trading accounts are the size where 1 or 2% can be represented in a Bitcoin, right? Like how many?
Well, you can play GBTC. I mean, there is an ETF now that actually tracks Bitcoin that's pretty popular. So you don't have to go long futures. You can play this ETF product. Now, there's no options on the product, but it does track.
Which means you shouldn't play it.
$12 a share, though. To answer Mark's question, you could have exposure, right?
They need options on that.
Yeah, I agree. We don't usually touch things without options. Back on Bitcoin for a second, though, I want to get a weekly chart, and I want to get Frank's take. Breakout Frank here on a Friday, and Bitcoin's on my mind. I know, Frank, this isn't one of your tradable instruments you use, but just give me a chart read on this if you can on the weekly, because I think 10K is very, very significant. Tell me what you're seeing.
Yeah, absolutely. 10K is a big number. We've got that pivot just above us, right? That's right in that ballpark, and a pretty clean path into that 12-ish area. I think if you are looking at a breakout candidate here, you want to see kind of like what we were looking at when we were looking at crude, where a little bit of a consolidation, give people the opportunity to take those profits, and good profits the last couple of weeks, right? Especially the last couple of weeks, give them an opportunity and let them pass, and then push through that resistance. Not a lot of overhead. You could sell me on this chart a week from now if we're still in the same ballpark.
Can I just say one thing before we move on from Bitcoin being an inflationary asset? Inflationary asset classes don't go from 2,000 to 20,000, 20,000 to 3,000, 3,000 to 1,300, 1,300 to 5,000, 5,000 to 10,000. They don't do that.
If there wasn't so much
Jim, they don't do that. They just don't.
I'm just going to make a very clear point. If there was not so many dumb Bitcoin analysts in the last 3 years that pissed you off, you might have a more open mind.
Listen, Tim, I have 200 ticker symbols I track, right? I just added GBTC to my list. I got to find something to bump now.
Interesting. Let me know what you bump when you bump one. It's like 200, like the S&P 500. All right, guys, that is our top-down analysis part of our market skyline. Obviously, a lot to unpack there with the jobs report, the Chinese analysis, and many of the other commodities. At this point, there's a couple things I want to say. Number one, if you're looking to learn top-down analysis, Matt, we have a great course on tackletrading.com. Cody, if you can find the link to the 7-step guide from Tackle Trading. It's a free course, and it's what we base our daily routine around each and every day. Frankie, in the pre-show, you were talking about your daily routine and how important it is to you, right?
Yep, absolutely. It's very easy to get overwhelmed with numbers and data and stuff. So being very consistent is vital, and especially for everybody. But for me, I'm not an organized guy, so it's really important that I'm boring because leave me to my own devices, and I'll do a lot but not get much done.
Yeah. So if you're new out there and you're watching our show for the first time, as always, come back and join us on the halftime show every day. Subscribe, click the bell, but start with that course. It's a free course.
Can I just say one thing about the 7-step guide? There's a lot of companies. Tackle Trading is obviously not the only educational company and stock company and whatnot in this space. There's other companies as well. And a lot of those companies will put out a 15-page PDF as a free download to get your email. That's not what Tackle Trading did. Tackle Trading did a 2-hour on-demand video series professionally done so that you guys could start understanding true top-down analysis in the marketplace. And there's 7 steps in that top-down analysis that we go through, not just from analyzing the markets, but finding trades and placing orders and managing trades and managing your portfolio. And so if you're very new to the market and you're wondering where to start, that 7-step guide to trading is absolutely where I would start.
Absolutely. Next segment we're going to be working into is Stock Talk, which is where we break down stocks and that have news or charts or information that we find is very interesting. I want to start actually with Disney if we can. Mark, overnight there was an announcement that the Shanghai Disneyland was opening their doors, and they were selling tickets online. They sold out. That was the headline. You dig into it, they're only selling 30% of the capacity so that they have less people in the park. But is that a good sign that the consumer is ready to go back out and do stuff again? I mean, how did you react to that?
On one level, I don't know how you say it's not right. Now there's a whole, here's my big picture on it. Like COVID-19, if we massively open up the whole society, then we're probably going to have a second wave or a large continuation of the first wave, right? Most people are on board that we just don't everybody go back to 100% normal. But if you stage these and build them out and have 30%, 40%, there's absolutely going to be demand on those 30, 40% levels, I would think. Now, can a business be profitable at those levels? That's a whole different question, right? But is there some level of pent-up demand? Probably, right? I mean, probably, especially for something iconic like Disney. So from a bullish perspective, that's very encouraging to see that type and that level of demand. But where was the theme park at again right now?
Shanghai.
Yeah. Shanghai.
Here's the thing about Shanghai though, right? Contact tracing, rampant testing, like they've done an excellent job with monitoring the virus. A premature reopening would get me to be very, very bearish on my stance because of what I believe the virus actually is. So, so for me, it's a mixed bag. I mean, it's great to see that demand's there. It would be great to get to the normal levels we are again, but Disney's still going to burn through a ton of cash at 30% capacity.
Well, that's a very important point. The fundamentals of that, it doesn't necessarily mean Disney's going to make money at 30% capacity. I mean, that's, obvious, Mark. I mean, they're burning through cash, right? You were just
I mean, that's the thing. If airlines only have 30% capacity moving forward, then airlines are all going to go bankrupt. Yeah. Like most businesses that have capacity issues, airlines, restaurants, malls, theme parks, SeaWorld, casino. MGM came out and said it. MGM said that we have to be between 30 and 50% full capacity in a casino for that casino to even us think about justify opening it.
Mm-hmm.
So
just to turn the lights on and open the doors, right? And bring staff.
just to not lose more money than we're losing today. The thing for me, MGM was very striking to me. They're like, if we aren't between 30 and 50%, there's no point in opening, because we'll lose more money doing that than we are losing today getting zero revenue.
Mm-hmm.
And that's very, very, very telling. So we got to return to really some semblance of actual normal before we get too excited about anything. And if we get to too semblance of normal, it's this chicken and egg thing. If we get to too semblance of normal too soon, what we know about the virus is it's going to spread rapidly. It's a really awful situation when trying to evaluate what companies to buy in this space, because none of the outcomes are really great that we have right now.
Mm-hmm. Maddie, thoughts?
I agree with what Mark said, but I mean, and it's difficult to analyze the COVID-19 and the risk with the COVID-19 in Shanghai versus, say, Orange County or Orlando, Florida, with Disney World and Disneyland.
Mm-hmm.
But I promise you, if once Disneyland opens up, they'll sell 30% of their capacity in less than 24 hours.
Yeah, they'll sell out the 30%.
I mean, there's 45% of the U.S. population that really doesn't even think this is a risk any longer.
Mm-hmm.
So yeah, I think people, and I also think people, even if they do understand the risk to the COVID-19 situation, there is so much pent up, and you can call it pent up demand, or we can call it pent up frustration, that we just want to get back out in society.
Yeah.
We want to leave our house, right? And even somebody like myself who takes this situation ultra serious, who, even though the state of Utah is opening up their businesses and so on and so forth, I'm still social distancing. I'm still wearing a mask when I go into a store. I'm still disinfecting things when I bring them into my house. I'm still talking. I literally told all of my family, don't talk to me about this stuff until you watch Contagion. After you watch Contagion, we'll have a conversation about it. By the way, I probably shouldn't have watched Contagion 4 days ago. But the reality is that even somebody like myself who takes this ultra serious, I have that pent up frustration that, yes, I want to get back out in society, right? I'm feeling the angst and I'm feeling the stress of just the stay at home and the social distancing. But I also feel like we have a moral and an ethical, responsibility to other people as well. So, I understand that. So yeah, my take on Disney, it's a positive result for Disney. Is it positive to drive the stock up 2.39% today? No, when you see it's only 30%, but it's a positive step for Disney. And if we do get behind this COVID-19 situation, I could see Disney at some point being a very good stock to add to your portfolio long term. I don't think that point is today. I've touted Disney for years and years and years as one of the best and the brightest of the bunch because of Bob Iger and, his leadership and what he drove Disney from the early 2000s to when he resigned earlier this year. But I do believe Disney is one of those brand names that is going to be around for a very, very, very long time. But I think we have to see a little bit more of the economic data before we start talking about adding Disney to a long-term portfolio. They have still tremendous risk to the theme parks. They have tremendous risk to sporting events and whether or not sporting events are going to go on this year and into the future into the same capacity to movie theaters and so on and so forth. So I think we're a little premature on adding Disney from a portfolio standpoint. Disney's not a stock you trade. It's just not. It's not one of those. It's a staple stock.
Mm-hmm.
It's one you add to your portfolio that you want to build your portfolio over the next 10 to 20 years. And so if we're looking to add Disney from a long-term perspective, I think we can be a little patient and wait for some of this economic data to come out, and also wait for how society, handles the COVID-19 situation as we start opening up the economy and people start going back to work and people start living their lives in some type of normal capacity.
Hey, Matt, will you record when Disneyland opens up at 30% capacity? Will you record the fight you and your wife have when she wants to buy tickets?
No,
Not going to happen.
I'm not going to record that fight. I will lose that fight in the moment, but I will win that fight in the long term. And maybe I'm just delusional in saying that.
You
I
are
was about to say,
delusional.
are you sure you're gonna?
I want to see that because
one?
Matt's wife loves Disneyland, right?
She didn't take this COVID-19 situation serious until Disneyland shut down the park.
You know, and so like when they announce like 30% shorter lines, like you get more of the theme park to herself and it's open. Oh, those tickets are going to get bought behind Matt's back, most likely. And
dude, if you are a believer that the virus isn't that
theater.
big of a risk, I mean, it's the time to go to Disneyland, right? When they have a 30% capacity, the short lines, the no crowds, all that kind of stuff.
No, you don't understand my wife. My wife understands. It could be full, and my wife understands all the tricks of the trade.
The fast pass system, all those little sneaky tricks they build into it. Let's talk Tesla next here if we can. Automakers are announcing later in the month, like Ford and GM and whatnot. In Michigan, they're going to be opening up by about the 18th, I believe. Tesla's actually opening up today. Here we are a week after the tweet, Frank, where Elon Musk came out and said stock price is too high. He was clearly stoned on Twitter. That's my opinion. I don't have any evidence of that. But if you go
stoned every day,
dude, if you go read his Twitter from last Friday,
he was going crazy he was going crazy.
Yeah. And now here we are higher. We're almost 10% higher than when he tweeted that, Frank. First of all, unpack the chart for me, Frank, if you can.
Well, I'm not a Tesla guy. I'm not a huge fan of it. But with all of that said, I mean, you have to respect the insane buying that came off of that 20. I think is the best way.
Delusional insane buying.
I mean, it was impressive. You know, sold off heavily. You know, on that tweet into the next day, and then it hits that 20, and it's like, oh, let's rock and roll. Now we know that people like to buy Tesla, right? Whether just because I'm not one of those people, I know there's lots of them out there.
Frank, you have tremendous risk in even announcing you're not one of those.
That is true. That is true. I'm sorry, Tesla people. So I don't bet against you if it makes you feel any better. I don't like this as something to trade. I don't like things that, at least in my head, a tweet can drive them crazy like that. I have enough worries in life. Kind of like that price movement though. You've got a lot of overhead, but I mean, like that tends to matter with Tesla. I think the big technical thing that you can bring out of this is where we now have support. It was our support zone before the tweet and the selling. We bounced very nicely off of that. So we have a pretty good idea of where a clean line in the sand is from a technical buying perspective. One reason I don't like Tesla is because it doesn't like technical. It's not very technically well behaved sometimes because it's such a fanboy-y type of stock. And I say that with all lovingness.
Well, and the randomness of any random day where Elon might tweet, it's like just the volatility in this company makes it somewhat untradeable, in my opinion. Matt, what about you? Do you think you can trade Tesla in any way?
I agree with Frank. It's very difficult to trade something where you can't get you can't map out the probability because you take into account some degree of uncertainty with how Elon treats the Twitter account. I mean, he comes out and says, they come out, release earnings. He's like, yeah, I don't understand why Tesla's so high. And then all of a sudden it's, 8% above where he made that tweet, right? But it's not just the uncertainty in terms of the behavior of Tesla. It's the uncertainty in the chart. Tesla can absolutely drive high in price, and then it could just get absolutely just smoked back down. But it's really hard to map out a probability of Tesla when you're looking at a swing trade, when you're in a trade 3, 4, 5, 6 days. It's just real hard to map that out. But it's not even just that. It's really difficult because of the volatility of Tesla to map out proper reward to risk ratios as well, because it doesn't behave technically the same way, other stocks behave. And there's a lot of stocks in the market. And for me, when you're looking at trading, investing is different. But when you're looking at trading, everything starts with probability analysis. Reward to risk ratio, you can map out secondary. But if you can't identify a visual identification of probability, it's really difficult to make that from a trading perspective.
One more on the news side of it, and then we're going to get into earnings roundup. Facebook real quick. And, just notable in my opinion, I think that one thing that we're going to see out of all this is news like this. Facebook is allowing their employees that don't need to come to the office to stay and work from home all the way through this entire year, Matt, they announced today. And I think a lot of companies through the lockdown are going to say, well, why do we have all this office space? Why do we pay all these utility bills? Do we really need that, or can we give people the options to work from home? I believe it's going to be a growing trend out of it. Matt, what do you think?
Well, we talked about that earlier this week. We've talked about it, a month ago, about you will see a movement, especially out of a lot of these tech firms, that, if they can maintain the efficiency in the workforce with somebody working at home, think about the cost savings you could have by not paying that massive commercial real estate properties, right? And so my biggest concern from a real estate perspective is exactly what you're just talking about. It's not necessarily in residential properties. I will be concerned in residential properties. I'm concerned residentially just in the short term. I'll be concerned in residential properties, 6 months to a year from now, if we start to see some really nasty, if we see the continuation of this nasty economic data that we've seen over the last 6 weeks. But in commercial properties, if companies, regardless of the economic condition, can add to the bottom line and show the investor class that they're going to show more profitability, more increases in revenue, and not lose the efficiency of the workforce, that does make sense at the corporate level. And so from a cost perspective, if you can cut cost, maintain your labor, maintain your efficiency in your workforce, then absolutely yes. But I do think it's still an open question if the workforce will maintain efficiency levels while they're staying at home, because there is still we've been working from home in some capacity for how long?
15 years for me. Yeah.
15 years.
Yeah.
We're experts in the work from home philosophy. Would you agree?
Sure. 100%.
And yet, every single day we get distractions.
Yeah.
Right. And we're not 9-to-5ers, right? We'll work from 8 till noon, and then 7 till 10 at night, or I'll wake up at 2 in the morning and do something. I feel like I work 24 hours a day sometimes. But at those traditional 9-to-5ers, can they maintain that efficiency? I still think that is a tremendous open question because of all of the distractions people do get at home.
I agree, Frank. I mean,
we got a 5-minute fight on the. We got a moving average breakdown on the SPY. We go to the SPY. We're fighting an intraday signal right now. We just gave it out on intraday support. Go to the SPY itself. You see a clear vision of this. You have continuous moving averages. It's so frustrating.
I don't know, Chucky. I think you're just going to fade.
Mark is hoping. Mark is.
Anyways, you have
here's the reality. Go ahead, Mark.
No, yeah, I mean it's a really good technical signal to the downside. You broke intraday support. You're getting some moving average downward signals.
Don't have a lot of support in the short term.
You don't have a lot of short-term support. So we'll see how scared the market is, because it's a really, really nice setup. A really nice setup.
And by the way, the end of Fridays are always very interesting to see how the markets do close and whatnot. We'll be tracking that throughout the day, and we do our weekend reports where we give you all of our analysis. And I think, Mark, you even have your Friday report you do here in about 45 minutes, I believe. Is that right? 45
minutes, just looking at, it's like, I love that there are 2 times of the week that are the most important to me. It is the last hour of trading, and it is the time, whatever time I put into the weekend to decide what I'm going to do on Monday morning. And then oftentimes I'll trade anything right during the week, but I don't do very much from an investing or a portfolio thing in the middle of the week. I'll use that for day trading. I'll use that for swing trading, like those sweet breakout setups we've seen this week. But for those investing portfolio decisions, it's, do I want to do anything to manage my portfolio heading into the weekend, and over the weekend prepare for what I'm going to do to start Monday, and then I have the whole week to trade, right? I have the whole week to trade. So on Fridays, I do a live class for pro members. You can go to the calendar at tackletrading.com. Same link for pro members out there. It starts at in 45 minutes, where we just look at and we just talk and we discuss. It's not an educational class. It is a, you know, what are some management decisions we could do on existing? What do we think? You know, and then I have a couple fun games I play with pro members on what they think I should do with my portfolio.
Fun games. This is the same Mark I know.
Well, listen, I don't have any of you there, so I can actually be a pleasant human being.
You stacking the deck to guarantee you a win. That's a fun.
That's fake news.
Listen, but those pro members have made me money. This is what I love about the community. They bring up stuff that I don't even think about. And they're like, hey, I have some naked puts on I've sold so many naked puts that have expired worthless just because they were doing it. And I was like, I want to copy that. You know, so like, I love it. It's them as much teaching me. I just sit back and just jibber jabber with my account while they talk to me about what they're doing most of the time. It's great. It's fantastic.
Well, looking forward to hearing from. I'm getting good feedback from the pros, so I'm glad that you're doing it. 45 minutes, guys, on the site. You can find it on the events page. Back on stocks here, we got still a lot to unpack here, guys. Many things, but I do want to get right into earnings reactions here, Matt. We won't go through every company that had earnings, but let's hit some of the big ones. I'm very interested in what happened with Booking.com. Matt, did you have a chance to look at their numbers?
Yeah, I do. I do got the numbers. Let me pull up the chart very quickly.
It's the old price line, you know.
You know, I used to trade price line with credit spreads quite a bit.
Mm-hmm.
I don't think I've traded it ever since they changed their symbol. What does that say?
They're just not as tradable as they used to be. That's true. I mean, they're not usually on my radar for short-term trades.
I just hate when companies change their symbol.
Mm-hmm.
I just don't like it. But their numbers came in at $3.77 a share versus the expectation of $5.09. Revenue came in at 2.3 billion versus the expectation of 2.2. And obviously, you know, when you're talking about, you know, Priceline, Booking.com, revenue is obviously going to go down, especially given what's going on in the last 6 weeks. Revenue did decline by 19.4% year over year.
Mm-hmm. It's surprising to me how bad some of the stuff happening with travel is, and they're still holding that pivot. Frank, is there anything in the chart there, pivot relationships, that would get you interested? There's a lot of clear air. I mean,
there is. You know, I think you still need some time, but I think this is one that is really hard to project in the next few days. We kind of need to see some upward movement, a little bit of a lower high develop, followed by a break of this weekly support zone. But if you flip that over to a weekly chart, it does look an awful lot like something that's really trying to confirm on the bearish retracement side. So probably a little premature, I would say personally, but I could see it being on a bear watch list.
Mm-hmm. Mm-hmm. Next one, Uber here. Mark, did you have a chance to look at Uber's earnings?
I did. Listen, Uber and Lyft, analysts, and there was a lot of euphoria, and it's this thing. This phrase has gotten a lot of play lately, and you even saw it out of the White House today, and you've seen it all earnings season long. The bottom is in as far as things can't get any worse. And they're using this, and the people saying, well, we're starting. In fact, I saw some genius on CNBC yesterday ask an airline exec, said, well, do you think the bottom is in? And the guy says, and he said, like Stoneface, he's like, we're down 95% capacity. I don't think it can get much worse, but they're using it as, hey, it can't get worse. Well, no kidding, it can't get worse. The whole society was locked down. And some would say, well, maybe it could get worse, big, huge second wave, right? But it's like they're using this as a rallying cry that Uber and Lyft started to see a little uptick in number of cars being used in the month of April. We would expect this, right? When the whole society's locked down, and we're not. But once again, the bulls are so in control. They will use anything out of an earnings report to justify upward movement. And yes, when you had a tremendous amount of rideshare go down, yes, it's going to uptick a little bit, but that's all the bulls need to jack it higher. That's all they need. But both Uber and Lyft are laying off a ton of their workforce, a ton. So they don't expect a V-shaped recovery anytime soon by the massive cuts they're doing to their employees, which obviously has a trickle-down effect to the.
Well, and the CEO on the conference call also promised more cuts coming down the road.
So like, but hey,
I mean, Uber's one of those fanboy
stocks.
See a
52% increase in Uber Eats orders.
I get it. And if you're an Uber believer, like it is one of those fanboy stocks. Some people are going to buy and hold Uber no matter what. To me, that's an ugly chart. And even with a positive earnings, I mean, yeah, you're up 5%. Doji just above the 200 into old consolidation. Don't you think you could find something better to get interested in here?
Maybe, but this is the first time since the 200-day moving average was established a couple months ago that you are above that 200-day moving average.
Here's the thing, and this is the Uber's Eat argument is hilarious to me because they don't make money with Uber Eats. It is not a profitable segment.
They don't make money in any aspect of their business model.
But it's such an unprofitable segment. Lyft in their conference call this week specifically said, "Yeah, we're not going there. That's stupid. Like we're not trying to compete in that area, like because it's not a profitable segment." So I'm glad it exists, right? Because
I agree. But Uber did shed $2.9 billion this quarter. It wasn't just on Uber Eats. It was on every aspect of Uber. There's not a company in the market that bleeds more money than Uber. Not a company.
It's got.
Yet it's still up 6% on the day.
No, listen, and no, zero interest.
Next one here, Roku, obviously another one of these fanboy stocks. And, there's all these movements about, having these Roku devices in your homes and whatnot, smart TV movements. A lot of people have been interested in this one. Matt, what do you see in Roku's?
Roku came in at negative 45 cents a share versus the expectation, negative 47 cents a share. Revenue came in above expectations at $320 million versus the $296 million. So numbers wise, very, very lukewarm. What I'm seeing in Roku though, and again, Roku being this nice little, growth type stock, the average revenue jumped per user by 28% year over year, which is a really good number for a growth-based company. Revenue overall grew at a 55.2% year over year number as well, which again is a really good number. Those two numbers combined, I mean, some of these other type of, I don't know if I'd put Roku into the fanboy stocks in the current market condition the same way, we've seen other stocks just take off like Wayfair and, Shopify and, those types of stocks. But I mean, the reality is, that's what you want to see. You want to see revenue growing at those types of numbers. And, I was a little impressed overall by their revenue growth and their average subscriber growth as well. Kissing off that 200-day moving average, there's no trade here in any capacity, but I wouldn't have too much angst if somebody's like, yeah, I want to add it to a watch list.
Next one, Monster Beverage, Marky. Monster, obviously an interesting one because you might have rising costs and things like that. Did you get a chance to look at Monster's earnings?
Yeah, same. Earnings were decent as a whole. It's the problem I have with all of the consumer staple packaged good type companies, right? Like no guidance pointing to that the sales were adversely impacted in the coming second quarter due to decreased foot traffic in the convenience and gas channel. So it's one of those like the Coca-Colas and the Pepsis and the Monsters. We got so much clarity in so many different companies. Monster does a lot of their sales in those gas station, right? People buying an energy drink in the convenience stores. And so how much of society returns to normal and what normal looks like is going to have a big impact in the second quarter earnings. I mean, Monster just flat out said that. So there's a lot of concerns. Like if I'm buying Monster, I'm not chasing some great high flying stock necessarily. I'm looking for more of a stable play. And I've just had a lot of hesitancy on the Cokes and the Monsters and a lot of these packaged goods that are outside of the Campbell Soup type companies where I have a pretty good idea what they're doing regardless of the situation. So not a terrible, listen, Monster's a good company, is going to make money, a reasonable company that if it were to dip to lower levels, I can see someone taking a stab, but chasing price action here, boy, that just seems like, why would you?
Beyond that, Mark, I mean, they've got a lot of history at around 66.50 where they bumped their head here today. That was a major resistance point in the past, support level. So an interesting fight, and then an overhead at 70 as well. Yeah, this is a tough one to get excited about with the placement today. Might like this, might like the situation, might not, but that's a pretty important price range. I believe we need to be keeping an eye out on.
And there's any other earnings, Matt, you need to hit? I mean, Dropbox, I was interested in.
I would say Dropbox we need to talk about. Dropbox here, DBX. DBX. Nice little reversal potential setup happening there on the weekly chart. Let's go to the daily chart here. Let's see. Let me get the numbers. Dropbox came in at 17 cents a share versus the expectation of 14. They came in at 455 million versus a 481 expectation. Revenue grew 18% year over year. With a growth-based company like Dropbox, you want to see revenue grow at a little bit higher rate, especially in this stay-at-home environment. You would think that a company like Dropbox, which is a cloud-based company, would do a little bit better in this environment, and it just hasn't performed in that capacity. So numbers were a mixed bag. Technically here, you got a mixed bag, both on the response to the earnings report. I don't see any trade there. From an investing perspective, it's a mixed bag here on Dropbox.
And that is stock talk. The last section.
Quickly, Tim. Very quickly.
Sure.
One stock. Just very quickly.
Slack.
We know who it is.
Come on now. How do we miss this one? We should have started stock talk with this one.
Yeah.
This is, Slack is a company that we at Tackle use for our personal internal. We've moved away from email completely. Every communication we do through our company is done through Slack. It's a company that's on one of our list with the Tackle 25 on the what we call the dirty sexy money list, which are not fundamentally strong companies, a lot more growth companies we believe in. Long-term Slack is, in my opinion, at one of the top of those lists. But we've been talking about this potential breakout of $30 for a very long time. Coach Noah said in Stock Talk yesterday that Slack is one of the stocks that he's focusing on. So I'm sure he's happy with that breakout of $30 here today. So for me, that breakout of $30 is really, really significant. And it looks like, we still got a couple hours in the trading day here, but it does look like we're going to close above that $30 mark for the first time. And that breakout to me is legit. When you look at it here on the weekly chart, a lot of choppy price action, but this is why I don't believe in IPOs. Look at IPOs. Boom, 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 boom. Consolidates. You get a proper setup. You get your moving averages starting to establish themselves. The 20 weekly, the 9 EMA weekly, all starting to move back up to the top side. On the daily chart, you're starting to see those moving average start to kind of expand themselves. Look at the 9 EMA start to expand from the 20. Look at the 20 start to expand from the 50. You're starting to see momentum going into that chart on the breakout. This is a breakout that I really like. If you're looking for reversal type setups, I know everybody wants to go pick the bottom at 1510, but that is impossible to do. You never try to pick the bottom. You wait for the proper setup. You wait for the reversal signal. You wait for those moving averages to catch up. You wait for the confirmation on the breakout. You violate that neckline right there at $30. And Frank, how many times have we seen $30 play a significant role in this market over the course of the last 3 months?
A lot.
A lot. And so $30 is almost like the new 20, right? And so in terms of this, I like that breakout of 30. And I think it's both tradable. And I think if you're looking at, adding a company that, in my opinion, is one of those companies that could, and again, this is just my opinion, but I do believe Slack can have the ability to revolutionize the way companies communicate internally with one another. I think more companies over the course of the next 10 years are going to be using technologies like Slack and others like Slack because, I do believe email might not be a dead form of communication, but how many emails do you guys get where you just literally just delete without even looking at them?
Oh yeah. Slack is so nice. It's so much easier to stay on top of what's happening. I love it.
And not only that, but as the head of a company, it allows me to track all forms of communication within the company to make sure that everybody's working with one another, that communication doesn't go by the wayside, because everything is there for everybody to utilize. I just absolutely love this company. I love the breakout.
Yeah, it's clean. It's very, 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 very clean. And good call, Coach Noah, yesterday. I think this one's been on everybody's watch list, but what a clean breakout there. Guys, last section we get into after Stock Talk is our Coach's Corner. And quite frankly, one thing I do want to remind everybody of here, and something to kind of promote a little bit, is our Tackle Trading Twitter. We've got Coach Frank, Breakout Frank, here on Fridays coming to join us. And Frank, you man that Twitter account. You're always putting good charts that are grabbing your attention, things out there. It's just at Tackle Trading. If you're on Twitter, make sure that you follow us on Twitter as well.
Yeah, come join us.
Frank, I'm going to give you the floor here a little bit. You got a bunch of candidates you wanted to run through. Why don't we start with you and just hit any stocks you want to talk about?
All right, sounds good. How much time you got? So these are some trade candidates coming into the first part of next week that have caught my eye. A little bit of everything. On the retracement side of things, I got a handful that are pretty interesting. ARMK, certainly one that caught my eye. They're in the restaurant business, but a nice little pullback, slowing momentum into old resistance, the moving average soup right there. If that's not your cup of tea, Expedia, EXPE.
I do like this consistency though here, Frank, in the upward movements in price, downward, upward, down, very consistent here. You're not only on those moving averages, you're back up above that 9 EMA, and you're kissing off both moving averages and a very consistent trend line. I like that.
And then, yeah, I really like it. And risk to reward solid, 2-to-1 approximately, just to that recent swing high. So very, very appealing.
Options on our mark aren't terrible either. So I mean, I'm looking at, because I like that setup too, right?
It's definitely one of my favorite pullbacks.
Cheap stock though allows you to buy shares.
So yeah, options aren't liquid too, exactly. And I'm never.
The options aren't too bad. I'm looking at the option chain right now. I mean, you got 10-20 cent spreads on the monthly options. It's not terrible.
No, it's not bad at that price. Not great, but not bad.
The longer terms are a little more difficult.
Yeah, I think probably the easiest way to play it is with stock. But
I would say the shares. I mean, if you're going to buy an option, you need to buy a little bit more time. Yeah, I mean, selling options, you can do those weeklies, but if you're gonna buy options here, you need to buy a little bit more time. I'd say the shares.
Yeah, I think
that chart caught my attention for sure.
That's pretty nice. You've also got Dow DuPont, or DuPont, the new DuPont DD. Another little retracement candidate popping out of maybe a little bit of a flaggy situation here today. Moved a little bit more than I was hoping to, confirmation wise, but certainly kind of going with the trend. Expedia, another one of those types, EXPE. And one other retracement that caught my eye, maybe not as, I don't think I like it as much as the others, but I do like it, URI, United Rentals. So definitely some pullback candidates out there that, didn't perform great this week, but didn't really perform terrible, kind of went nowhere type of a deal. And if this is a stock picker's market, then we're going to see things move in and out of different, industries, right? If that's what we are in. I got a K-trade candidate too. I really like for a K-trade being NTR, Nutrient. Nathan Thomas Richard. Got a pretty clear level of support around 34, ballparking there. Pretty clear level of resistance around 37. Not a lot in the path on either side, so might be a little developer, but I think this is an interesting K-trade candidate personally. So I'll be keeping an eye on that side of things. On the breakout side, not as many breaks. Obviously, we talked work. Definitely something to like there. QSR. Restaurant brands, little bit of a higher base type of break developing there. Not a lot of clean breakouts this week. You also have MIC coming out of a consolidation period, short-term consolidation period as well. So if you're looking for a breakout, couple.
What was the last symbol, Frank?
MIC, Matt Iron Condor. So coming out of it a little bit here today, but again, one of the things that I'm always looking for is that risk to reward. right? And because I'm going to have plenty of candidates to trade, so I'm trying to find things that have those clean, identifiable, repeatable entries that are giving the best risk to reward ratio that I can possibly find. Because hey, I might be right, I might be wrong, but I'd like to get paid if I am right. So VRTX, one other breakout candidate probably worth mentioning. I almost forgot them. Really just hovering this week at the top. You know, healthcare didn't have a great week. You know, as a whole. A little bit of selling, a little bit of consolidation, but certainly a breakout. You know, maybe another little time. Maybe we need a little more time to turn on this guy, but I think worth keeping an eye on. On the bear side of things, probably my favorite bearish candidate going into early next week is Vulcan Materials, VMC. Loving the way that they've kind of developed over the course of this week, testing and holding support. A lot of selling pressure here today. Obviously has not broken through support, may never break through support, but not.
I like this one, Frankie, though, and I like it quite a bit for a couple different reasons. You got that upward movement in price, but then you have a nice little M formation starting to form on the daily chart here. You know, overhead resistance at 115, but that support level, I just get geeked out when I see a nice little double bottom here. With a little bit of consolidation right at $100. I mean, that's a significant number. And what do we always say? If it breaks above 90, it goes to 100 every time. If it breaks under 100, it goes to 90 every time. Now, obviously, we joke about that, but we do see that quite a bit.
Yeah. That's probably my favorite bearish, you know, that could happen, you know, early next week. Although XYL is in the running as well, and they need to slow down, or they're going to trigger before the day is done. XYL, big gap down on earnings, have put in a very clean weekly floor, testing it again here. It looks like as the week comes to an end. Not the same room maybe that you have on some of the other, you know, bearish candidates, but not really nothing until you get down into that 50, you know, mid 59 range as far as support is concerned.
Love it. Love it. Awesome chart analysis as always, Frank. I mean, you're the breakout king for a reason. A couple from me real quick here, Matt. Nike, only two from my side today. I'm interested in the breakout up here because it would clear above the MAs. And if you are going to get that reopening theme to just run the market out of euphoria, a company like Nike could easily participate.
What did we just say about breakouts of 90, T?
If it breaks 90, we're going to 100. So,
okay, and that's also breaking the 200-day moving average as well.
Yeah, and there's a lot of history there too. It's not just this last couple of weeks or months.
Oh no,
there's a lot of history there.
Look at that history.
Yeah, it'd be pretty clean if you can get a breakout. Obviously, I'm going to be watching that one next week. And then one, if you are looking for a bear thesis here, Mark, I think the banks, BK. I mean, look at BK here real quick. I mean, you guys were looking at some of those reversals in industrials. We saw some of them yesterday. Financials underperforming is a head scratcher for me, and I still have very big concerns. I think it might be a value trap. Everybody's looking at the financials as dividend payers and this and that. I mean, we've got people on unemployment. The consumer coming back is still a hypothetical. We don't know that. They're out of the earnings season, out of everything we saw, I think bank earnings were the worst out of any sector.
Well, why is it a head scratcher that they're underperforming?
Well, because if everything was fine and they're all going to just have free money and the credits are cheap.
But one of the things that has come out from the sentiment and the chatter, and get used to this phrase, because I think you might be hearing it a lot, is that there are two economies. You know, like, I mean, I heard that phrase used at least 10 times on CNBC this week, that there's two economies, and there's the one, the tech and all of that, and all of those companies that you saw just kill it this week. They're part of the one economy. Banks go on the other part of the economy. I mean, how do banks make money if they can't lend money and if they're scared to lend money?
So, and do we really see banks coming out of this environment aggressively loaning at historical low interest rates when the most likely scenario with the interest rates over the next 2 years is going to get even lower in an environment where we have an uncertain economy in the future, and the banks know that uncertainty in the future? We've heard that from the banks. Do we really think the banks at a historical low interest rates are just going to be aggressively borrowing money?
No.
How do they make money?
Point. No, it's a double whammy for banks. Not only are interest rates lower, but the chance of default is higher, and so they're not going to be lending as much unless you're a preferred credit. Go see how easy it is to get a home loan today compared to what it was 2 months ago. It's not a great environment for banks, right?
Well, and it's kind of a take your pick. I looked at all the bank stocks, and Matt, you're on Bank of America here, very liquid as well. That breaks that triangle to the downside. You got downside. BK has downside. We talked Wells Fargo. The XLF, I mean, the two economies thing, I'm going to have to wrap my head around, Mark. But it's a
Take
very
a shot out there, drinking game. Wrap my head around. Tim said it. 12:08. Go take your Friday shot.
Everybody's got to go take their shot, drink of choice. But there is two economies starting to form here. You're starting to see separation within certain industries, certain sectors of the market. You're starting to see certain industries outperform others by a dramatic measure. Tech, healthcare kind of stand out in that environment. Those stay-at-home stocks stand out in that environment. And these traditional, value type plays like energy and, financial and utilities. I mean, in this environment, guys, wouldn't we expect utilities to actually perform decently? And yet they've been one of the worst performances in the market.
Heck,
so I absolutely buy into the argument that we are starting to see two economies start to separate themselves, especially from a stock valuation perspective.
I think XLU is one of the worst sector charts, actually. I mean, if you look at that, it's like XLF, both of them sitting down here near support, riding on the downside of these MAs. If they break down, I think they both have downside, so.
No, and here is the biggest problem and the conundrum I have as far as doing a directional play or putting in money at levels is you got the one economy that stinks: banks, restaurants, retail, airlines,
industrial, energy,
all of that, and that you're like, ew. I don't know if there's going to be a second wave of the virus. I know that behavior is not going to return to robust. And then you got the other side that, because of the market rally, has these nosebleed valuations. What am I supposed to do with PayPal at a 50 PE? What am I supposed to do with Salesforce? What am I supposed to do with Apple, where I'm having to pay a valuation that is insane, that is absolutely insane comparatively to what it has been? And so it's like, okay, I have the one economy that stinks. I don't want that. Yeah, I want some of this other company, but oh my gosh, the valuations are insane. Like that smells like trouble for the bulls moving forward.
Very interesting. All right, guys, let's
answer Arnold's question. He says, how does negative interest rates affect bank stocks? It depends, first of all, Arnold, what's the economy doing at the time, right? And if we do see a recovery in the economy and you start to see consumer confidence start to increase, and if the banks are willing to take on the risk to default, and that's a big if the banks are willing to take the risk to default, you will see an increase in bank loans, because banks will be able to borrow at an extremely cheap interest rate and still be able to charge you at 3%. And so they'll be able to borrow from the regional banks, because this is how interest rates work. The central bank is the one who creates the Fed fund rate. It's the regional banks who borrow from the central bank, which are owned by the central bank. The local banks, i.e. the banks that all of us deal with, they therefore borrow from the regional banks, and the interest rate compounds to the downside. So when the Fed has a 0% interest rate, the regional banks are borrowing, say, at 1%, and then the local banks are borrowing, say, at 2%, and then they're charging you an average on your loan at 3.5% or on credit cards at 15%. So that's how they traditionally will make money, is through that interest rate. But that's a big if when it comes to consumer behavior. And most of the banks right now are being very, very conservative in terms of their economic projections of what they see in the next 6 to 12 months to 2 years from now. So even if the economy recovers, I'm not sure the banks will take the risk to default. The second way banks make money, and this is what a lot of consumers don't understand, and this is a bigger form of analysis, is the fact that it's called the carry trade. And so the number one trade in the last 10 years was not buying Google. It wasn't buying Microsoft. It wasn't buying Amazon. It wasn't buying any stock. It wasn't buying any commodity. The the number one way institutions and banks make money is they carry a positive interest rate. And how you carry a positive interest rate is you will buy a currency with a larger interest rate, thus selling a currency with a lower interest rate. But in an environment where we see the United States Central Bank with zero interest rate policies, the Bank of Japan at a -1%, the Swiss franc at a -1%, the Australians at a 0.25%, the New Zealand's at a 0.5%. When you look at this scenario, it's very, very difficult, which equates to $14 trillion, guys. It's very difficult for banks to make money on carrying a positive interest rate when every central bank around the world has a very similar interest rate environment. And so because of the risk to defaults in an uncertain economic environment, even with extremely low interest rates, and because most interest rates around the world are somewhere near zero, even Norway went to zero just the other day. Because of those scenarios, it's very difficult to see banks thriving in this environment. And I hope that helped you out, Michael.
Dude, that's
you guys need to do the podcast on Monday on. Listen, I'm not going to be there because my daughter's having her tonsils out. Obviously, I'm going to be focused on that. You guys just need to go ham and talk Fed for like an hour and a half.
I haven't had a good Fed talk for a while.
Like, seriously, it's time, right? Like, go do it. Like, just get it out.
I just get depressed, though. I did.
Yeah, make sure you listen to it.
my old conservative fiscal heart. I get saddened. My Adam Smith capitalist heart. I get saddened whenever I see what the Fed has done to destroy monetary policy over the last 12 years. I get sad.
Negative interest rates in your future, most likely. Fed funds are pricing it. We'll talk about it. We'll figure out what we're doing on the podcast on Monday. By the way, the Trading Justice newsletter is up on the site here today. Go check that out at tradingjustice.com. Guys, that is our show. What a wonderful one. Really enjoyed it. Frank, as always, thanks for being here, my friend.
It's my pleasure. Thanks for having me. Always fun to hang out with the halftime crew.
Yep. And Maddie, take us out here. Talk a little bit about our pro community.
Two things real quick before you get to that. My show starts in 15 minutes for pro members, and oil and gas rigs fell below 400. Report out in the last hour for the first time since 1940.
Mm-hmm. Mm-hmm. Maddie, take us out. Subscription, 15-day trial, all that kind of fun stuff.
Yeah, guys, if you're new to our channel and you're new to tackle trading, the first thing I would do is I would go sign up for that seven-step guide to trading. We posted the link. You can also find it on our store page. It's a free download. You just got to put in your email, and we'll send you a nice little PDF with the links for the 7-step guide. But if you enjoy what we bring to the table, get over there and become a pro member of our community with the scouting reports, our traders lounges. I mean, we do this halftime report for everybody to walk you through the markets on a daily basis. But we have about 15 other live webinars that we do on a weekly basis. That is for our pro level community, that we go into a lot more in-depth analysis, not just from a trading perspective, an investing perspective, but also from an educational perspective as well. Right now, what we're going to be doing is we're going to go get into our scouting report meeting and prepare those reports that we put out to our community, the Tackle Trading newsletter, the stock report, the options report, the Forex report, as well as the commodity report coming out to our pro levels community on Saturday, so that our community can get ready for the market on a weekly basis. And guys, with that said, thanks for watching this show. Thanks for being a great part of our community. And if you have not yet subscribe to our YouTube channel so you get notifications when we do go live. Make sure you hit the subscribe. And if you do like our show, the best way that we've grown our community is word of mouth, and we really appreciate all of you guys helping us grow this community. So if you do enjoy it and it helps you navigate the market, share it with a friend. We've seen tremendous demand in quality stock education, options education, and so let's get the good message of tackle trading out there. You guys are the best. We love our community, and yes, to all the mothers out there, happy Mother's Day. You guys are the best in the world, and so I hope you mothers out there have an absolutely wonderful, wonderful, wonderful Sunday.
And I appreciate
sons out there. Make sure you're wishing your mother, Mark and Tim, a happy Mother's Day as well.
I forgot about it until Coach Emily put it in the chat, so I'm glad.
Listen, I got Mother's Day. I got a few baby mamas, so I got to make sure to.
I don't think you know how many baby mamas you have.
Listen, I got some, right? Like, so it's what it is, right?
All right. All right, guys, we're out. We'll be back on Monday. We'll see you
Have
then.
a great weekend, everybody. Thanks.